Welcome to today's broadcast. This is Christopher Calandra, certified financial planner, founder, and lead advisor at Osaic Wealth Management Services. This is the first of two economic updates that we will be putting out there as we look forward to 2024. Today's episode, I have a repeat guest, and I'm so excited. I know I'm a geek, but I'm so excited to have him back on to talk about the economy. I'm speaking about Jordan Jackson with JP Morgan, global market strategist. I got to see him on CNBC recently, and I was so happy. I'm like, there's my friend Jordan. He did a great job on CNBC. He's done a great job for me in the past, and I expect he'll do a great job for all of us on today's discussion. So hopefully that was a good opening intro for you, Jordan. Thanks for joining us today.
That was fantastic, Chris. Happy New Year, and thanks for having me back.
Yeah, Happy New Year. So a lot going on and a lot for us to get through. JP Morgan, of course, a premium brand name, a leader in the investment banking universe, been around for seemingly ever, puts out great research. So you put together this presentation that listeners can follow along with if they want. And the research that you presented to me starts with sort of where we are economically and the idea of a soft landing. So maybe we could start there. Talk to us a little bit about the soft landing base case.
Absolutely. So I think I can most succinctly describe our outlook for 2024 actually using the numbers 2024. So we think that growth is going to end the year at 2%. We think zero recessions, inflation trending down towards 2% and reaching 2%, and the unemployment rate averaging roughly 4% over the course of this year. And that's really that soft landing, and you could almost argue potentially a no landing scenario. Now, how we get there, we do believe that growth is going to take a step down over the first half of 2024, just recognizing the long lags of monetary policy weighing on overall consumer spending. Obviously, you still have higher mortgage rates that are weighing on overall housing and construction activity, although that may be reversing course a bit here. And then we anticipate growth to start to come back towards a more trend-like pace over the back half of 2024 as the Fed starts to ease policy. And I know we're going to get into a lot of these sort of specifics in the next few minutes. But that is really our base case. We ended the year strong. Third quarter growth was strong. Fourth quarter growth, we are penciling in about a 2% growth rate to round out the year. And in fact, that will allow for year-over-year growth, so 2023 growth over 2022 growth, to come in about 2.7%, a very strong number historically. So ending the year strong, we think we're in for a bit of slowing in the first half of the year, followed by reaching that more trend-like pace in the second half. And again, that base case falls down to, again, 2% real GDP growth, zero recessions, 2% inflation, 4% unemployment.
So that was so well said. I love that. 2024. This base case that JP Morgan has means that the Federal Reserve, led by Chairman Jerome Powell, then gets a lot of credit for the recent handling of inflation, don't they?
I'd argue so. Certainly, the tightening in monetary policy helping to weigh down demand and bring down overall inflation. But we have to remember a lot of the disinflationary impulse that we were getting through the back end of 2022 and through 2023, a lot of that was supply chains easing and things improving. And so that really helped to bring down inflation. And obviously, that was further aided by aggressive monetary policy tightening from the Fed. I do think now the Fed feels confident, and we've seen that the U.S. economy can weather policy rates above 5%. We've been there for the better part of the last 6 months. The last rate hike was in July of last year. So we've been at north of 5% in policy rates for about 6 months now. And we've actually seen growth reaccelerate, not necessarily take a step down. And so if the Fed can be patient, if the Fed can be cautious over the course of this year, again, we do think that the economy can ease into a soft landing and avoid a recession.
Very good. This base case, Jordan, that you laid out very effectively, this is not contrarian, right? I mean, this is consistent, correct me if I'm wrong, with conventional wisdom on the street. This idea of a soft landing has been widely embraced. Is that a fair characterization?
I think so. I would say it's more reflective in risk asset prices, things like stock prices, stock valuations, less so in the bond market. And when I look at valuations in the equity market right now, equity market valuations are sitting at about 19.5 times forward earnings. I do know this is somewhat skewed by the larger companies in the index, but historically that's a little bit elevated from a valuation standpoint, particularly when you take into account the level of interest rates in the broader economy. And that suggests to me that risk assets, stocks, are pricing in that soft landing, that companies are going to continue to be able to grow earnings this year, that the economy is going to do well, and as a result, stocks should continue to move higher, and they have. We've seen a bit of choppiness at the very beginning of January, but I
Yes.
think November and December, that very strong performance that we saw through the end of 2023 is reflective of that sort of consensus soft landing making its way into risk asset pricing. Now, the bond market, on the other hand, the yield curve, which is sort of a measure of sort of the expectation of both policy rates and how the broader economy is going to handle tighter policy rates or higher policy rates, that is still inverted. And so short-term interest rates are still higher than long-term interest rates. And that has historically signaled a recession. Moreover, right, the curve has been inverted for quite some time now.
Yes, it has.
And that has historically been also a decent indicator that a recession is on the horizon. So there's some mix in sort of pricing, but you're right. The street's general consensus is that a soft landing can be achieved.
So I've been in the business for, in May, it'll be 32 years. It's just a little sad that I'm now 53 years old, but I've never seen an environment where you had a recession call, that a recession was imminent for what, 20 months, 22 months, 24 months, and it has yet to materialize. It's really sort of a crazy turn of events that we've been waiting and waiting and waiting for this recession, yet it has not arrived yet.
It's truly fascinating. There's I think a couple of things that have played out. One, we had not seen the Federal Reserve tighten policy rates as aggressively during this hiking cycle since the 1980s.
Yeah,
In terms of speed and in terms of how much tightening, in terms of 500 basis points
that's right.
worth of higher rates. And so many of us, the traditional economic textbooks, and many of us have experienced previous rate hiking cycles. It's really hard to get it right and avoid a recession. And we leaned onto sort of historical precedents that when the Fed tightens, and when they tighten very aggressively and as aggressively as they did, you get that slowing down in the broader economy. And many of us expected it. Wall Street expected it. Businesses expected it. And to some extent, maybe all those expectations allowed us to prepare for it, allowed businesses to prepare for it, allowed consumers to prepare for it. And you see that when we saw rates near zero before the Fed began tightening rates, the amount of refinancing activity that consumers did for what we know as their largest liability item for many Americans, their home. The average effective, for those who have a mortgage, the average mortgage rate for homeowners that have a mortgage today is at about 3.8%. That is a big spread from if you're stepping into a new mortgage
That's right.
with interest rates in the high sixes, low sevens. And remember, these are 15-year fixed, 30-year fixed. These are payments that are not going to change. And so there was this massive restructuring of consumer balance sheets, geared towards low rates. And I think this has helped to continue to propel consumer spending. Consumers have certainly felt the pinch at the pump when they're buying a dozen eggs, a gallon of milk. They're seeing it
Sure.
in inflation in everyday prices. But I don't think they've really felt it from an interest rate perspective.
Yeah, I really appreciate that point of view. I had not considered it, that so much talk about a recession and the expectations for a recession, everybody reacted to protect themselves. Families did, businesses did, large and small, the government, and maybe that was enough to ward off a recession. We'll wait and see. But I also will add that I know you're not supposed to say this time is different because you're often proven to be silly looking. The distortions from the economic shutdown that happened during COVID and the resulting effects, like the supply chain disruptions that you mentioned before, if we do avoid a recession, I think that will also be a big part, that all the textbooks don't account for the uniqueness of what the world, what the United States went through the last couple of years with COVID and the healthcare part of things and the economic ramifications of that.
Great point. When you think about labor markets and the shift that we've seen, we have now have the unemployment rate below 4% for 25 consecutive months. The unemployment rate has not been that low for that long. You have to go back to the 1960s, well over 50 years ago. And a big piece of that has been some of the distortions, particularly amongst the supply side of available workers in the U.S. economy. As a result of the pandemic, we saw over 2 million retirees really through that period in April and May of 2020. And that's a big hit to overall supply of labor. You also saw immigration come down significantly for obvious reasons for a while. This is a big source of labor in the U.S. economy, and so this has kept the unemployment rate very, very low. This has kept wages, while wages have gradually come down. I think we're starting to see signs that they're remaining pretty sticky at around 4 to 4.5%, which makes some sense in my view. If our base case falls out, where you have 2% real GDP growth, 2% inflation, in theory, then you should be able to have, or 2% productivity, I should say. So 2% real growth, 2% productivity growth. Then in theory, you should be able to have 4% inflation, wage inflation. And that's pretty much effectively right where we're at. And so there's the distortions both in supply chains, distortions in the labor market, and obviously the significant amount of fiscal support, which has more or less been wound down, but certainly part of the equation that kept overall economic activity afloat coming out of the pandemic over the last 2 years.
So I want to talk about the consumer in a moment, but it seems to me, and I don't have the data at my fingertips, but during the Trump administration, and may even have started at the end of President Obama's administration, unemployment was below 4% for a very long time. So again, I don't have the data at my fingertips, but my sense is that the economy has been below 4% for a very long time, with an interruption due to COVID, which was not primarily an economic event, although it certainly became one. And if that's the case, the unemployment market has been very strong for a very long time, except for that abysmal period during COVID. Am I remembering correctly how low it was during the Trump administration and maybe even towards the end of Obama administration, a long stretch of 4% or less unemployment?
Yes. So if you actually look, really in 2018, 2019, you did see very, very, to your point, very low levels of unemployment, sub 4% unemployment. And that went on for about a year and a half or so. And then obviously we got the shock of the pandemic shock in April of 2020. But I think noticeably it's, to some extent, it's not so much about the level of unemployment, but the ability, or the level of the unemployment rate, but the ability of the U.S. economy to continue to add jobs month over month. And coming out of the GFC, where the unemployment rate peaked at about 10% in October of 2009, it was a steady march lower in the unemployment rate for the better part of a decade. And so the economy
Okay.
was continuing to add jobs, and that's really the crux of how an economy can continue to grow. You've never had a recession in which payroll gains have been positive month over month.
All
And
right.
that's why those two consecutive quarters in early 2022 of negative GDP growth, in fact, did not constitute a recession, because we added a lot of jobs in the economy for the full year of 2022.
Very good. Thank you. Thank you. So let's talk a little bit about the consumer, because to avoid a recession, for the base case to play out, the consumer is going to have a big say in that. Talk to us a little bit about JP Morgan and your thoughts on where the consumer is.
Yep, that's right. We always think of the consumer as the engine of the economy, and indeed, it accounts for about 2/3 of overall economic activity. So if the consumer goes to a large extent, so goes the economy. And the way I've been describing the state of consumers is, I think consumers are bending, but not yet breaking. So where's the bend happening? Well, we talked a little bit about savings. We view savings as the bridge to allow consumers to get to the other side, assuming under a period of economic stress. And obviously, consumers amassed a significant amount over the course of the pandemic, over the economy. We estimate that consumers have built up about $2 trillion worth of excess savings. Now, the concern is that pretty much all those excess savings have been spent down. They've either have made their way into capital markets, they've made their way into spending down existing revolving debt. And again, a lot of that savings has more or less fully been exhausted. Other areas of the bend, when you start to look at delinquencies, and so consumers defaulting on loans, when you look at auto loans, credit card loans, once we get fourth quarter data in, student loan payments kicked back in October of last year. And so those delinquencies are probably going to start to move higher as well. But we're seeing those delinquencies move higher across the board, not at levels that we were at in 2007, but they are creeping higher, and it is something that we're watching very, very closely. So that's sort of where the bend is happening. But again, I think, and we talked about this a bit, the consumers are not yet breaking for a couple of reasons. One, it goes back to that big reconfiguration of consumer balance sheets over the course of the pandemic, right? Catering those large liability items to super low rates. And if you look at a debt service amongst households, it's in a pretty attractive spot. Prior to the financial crisis, consumers were probably spending somewhere in the low double digits interest payments relative to their income. Now that number is at around 9-10%. So a much better sort of balance sheet, or stronger balance sheets amongst consumers. Then the second piece that could keep consumption growth healthy, or at the very least firm, is the fact that you have a tight labor market. And
Yeah.
now inflation is more or less under control from the Fed's perspective. Wage inflation, which is now running at about 4.3% year over year, is running above overall headline inflation. And so consumers are actually seeing real positive wage inflation, which has historically been a very powerful feed through to broader consumption growth. And that, at least that is a couple of the reasons why we think we're looking at a period of slowing economic activity, not negative economic activity, over the first half of 2024.
Yeah, and early in the inflation cycle, early in the Biden administration, when you had inflation really spike, the administration and economic forecasters worried that we were having wage gains, but they were not keeping pace with inflation. And that was true for a period of time. But based on what you just described, that sort of has righted itself, because if we keep wage gains averaging at 4+% and inflation's being driven below 4, in the 3s now, you described at the beginning of today's discussion, trending it towards 2, that is a pretty healthy result, and shows that what might have happened where you had the delta between, yeah, wages are going up, but wages are still falling behind because of inflation. That might have just been a temporary blip, but not something that was really sustainable. And now we're on a much better footing. Did I describe that right?
I think that's fair, but I will caveat and say, if you were to look at over the last 3 years, the cumulative aggregate increase in overall inflation relative to the cumulative move higher in nominal wages,
Yeah.
wages has not fully kept up with the cumulative move that we've seen in aggregate prices. Another
Okay.
way to say that is um, consumers still feel like consumers are still paying a whole lot more than they once were prior to the pandemic, and they still feel that, they still
Oh,
recognize
yeah.
that, right?
And that
Going
shows up, yeah, and that shows up, not that we're going to talk a ton of politics, but it shows up a lot in the polling I've been describing to clients, describing the American population as in a sour mood. And a lot of that is inflation and what people are spending their money on every day, food especially top of mind. It's been shocking. And certainly in lots and lots of instances for American families, that increase in food prices hasn't even come close to keeping up with wage gains.
No, that's absolutely right. In 2019, if the average cost for a family of four on a household items was somewhere in the $300 to $400 range, now it's probably somewhere in the 5 to 6, maybe pushing closer to $700 range. And again, while wages have improved over that time horizon, they probably haven't fully caught up to where that
Sure.
same feels comfortable consuming the same amount of goods. Now they are starting to see or have been seeing gradual wage increases, and so long as the increases in broader basket of goods and services sort of moderates out, and we sort of can see wages continue to keep up,
Yeah.
then in the next couple of months they might start to feel a little bit more comfortable about these sticker items. But I think we're at the very least situated today in a position where consumers can start to feel a little bit better, just given the wage dynamic going forward.
Excellent, excellent. So switching gears slightly, I want to spend a little bit of time talking about the finances of the federal government. This has been in the public square for a long time, and my personal opinion, Jordan, is that um, even though it's been talked about for a long time, like almost my adult life, the debt, the deficit, it's been an ongoing problem. It does seem to me that we are approaching the time when it will have to be dealt with in some way, where up to this point, it's mostly been, we've been able to get by as a country, as an economy, but I think I wouldn't say a reckoning is coming because that sounds too dramatic, but I do believe that we're moving towards a point where it needs to be addressed. So can you talk a little bit about you and JP Morgan thoughts on where we are with the federal finances, the debt, and what that might mean for risk?
Sure. Yeah, I will say that the deficit and the overall debt we think pose still some more longer term structural issues. We don't think it is a short term issue, say over the next 1 to 2 years, but and I don't think it's going to, while it may be talked about amongst academic circles leading into the election, I think the broader public is going to be more concerned around geopolitical risk, around inflation. Those topics probably will permeate onto the top of the campaign trail. But yes, deficits are set to rise and are expected to average between 5 to 7% of GDP over the next decade. Deficits obviously fuel the overall debt. And so we're now expected to go from about a 97.5% overall debt to GDP up to about 120% of debt to GDP over the next decade. Now, there are a couple of issues with this. One, when you look at, obviously the Fed has raised interest rates very aggressively, and this feeds in through the overall cost to service the debt. Now
That's
that
right.
debt has continued to move higher, actual interest costs to service the debt is going to take up about half of the overall deficit over the next decade. And that's particularly important because about 40% of US government debt is owned by foreign investors. And so you can see where an outsized share of our overall deficit going towards making interest payments that thus go overseas can put some long-term downward pressure on the value of the dollar and potentially import some very much unwanted inflation. That's the first point that I would make. The
I'm
second
with
point,
you.
the second point that I would make is if you look at the breakdown of government spending, arguably about 75% of it is non-negotiable. It's in entitlements. It's in things like
That's right.
Medicaid, Social Security, defense spending. And historically, a spike in the deficit led to a spike in or a pickup in overall economic growth, right? That's when the government starts to get to spending in the economy. The idea is to help the economy get back from a period of economic weakness. That's what we saw coming out of two world wars. But today, historically, the biggest impulse to economic growth was actually non-defense discretionary spending, right? That is sectors like education, transportation, government spending that actually employs people, puts people to work. That creates overall economic activity and jobs in the economy. But as of last year, that only accounted for about 15% of the overall budget deficit. And arguably, given that interest costs are moving higher and entitlements are, it's almost impossible to negotiate away, that share is probably going to get smaller and smaller because, as you pointed out, Chris, if we're going to right size this ship, you're either going to have to raise taxes or you're going to have to cut spending. And so you can easily paint yourself a picture in which not only do rising deficits potentially put downward pressure on the value of the dollar, but we're not going to gain the same amount of economic growth that we once did historically by increasing the overall deficit. So this is an unsustainable trajectory. Again, we don't think this poses significant near-term risk, but we are monitoring the impacts that this could have on the broader economy going forward.
All right, good. So moving away from the government finances, last year, just quick summary, get your thoughts, is the market had a very nice year. Most major market indexes experienced a healthy rebound over a difficult 2022 calendar year. But it was very unequal and sort of top heavy. And maybe you could talk a little bit about that and how it might play out in 2024, because it's probably not sustainable to have, the top 10 stocks carry the performance for almost the rest of the market, sort of like we did last year. So can you talk a little bit about that?
Sure. Well, market concentration was certainly a theme over the course of last year. And to be fair, I think it's going to continue to be a theme over the course of this year. Right?
Really? Okay.
The reality is when you have 7 stocks that account for 25% of the index, the top 10 stocks that account for about a third of the index, the truth is you kind of need these stocks to do well in order for the broader market to do well. So, I don't think index concentration is going to go anywhere anytime soon. But I do feel confident in that we will see a more broadening out in terms of market performance. You will see the other 495 play a little bit of catch up, even if you see a little bit of a wobble in the top 10 names. Part of some of the challenge from a valuation perspective on the market, if you actually look at the top 10 names, they're the ones that are drifting or causing valuations in the market to drift higher. They're the most expensive names, generally speaking, in the broader index, whereas the rest of the index, is actually somewhat undervalued or trading at close to fair value. And so we think there is, potentially more opportunity in the other parts of the market. But this is not to say that the Magnificent Seven won't continue to be magnificent, particularly in an environment in which we have that soft landing and the Federal Reserve starts to ease policy rates sometime over the course of the back half of this year. And I will also mention that these big companies, which are sort of traditionally in the growthier categories of the market, are actually really strong companies. They are profitable companies with strong balance sheets, and they're putting their money where their mouth is in terms of spending and on efficiencies. One of the charts that we have in our guide, it actually looks at corporate cash as a percent of current assets by sector. And for me, that is just a quick look at balance sheet health, how strong balance sheets are. And all of the growth sectors have an elevated level of cash balances relative to value-orientated sectors in the broader market. And remember, they're actually yielding something on their cash nowadays, right? They're yielding
That's true. Yeah,
percent on those cash balances, and so they've got strong balance sheets. And then when we look at overall spending, they're spending above on research and development and traditional capex. They're spending more than they have been on average over the last decade. And then when we break it down even further, they're spending an outsized share of that overall aggregate spending on R&D, research and development. Think generative AI, think blockchain, think productivity enhancing technologies, and all of these have pretty significant implications for overall long run growth potential among some of these companies. And so, while they may get a bad rap in terms of current valuations, looking at
that's
earnings
right.
for the next 12 months, when you sort of right size and look at earnings potential over the next 3 to 5 years, valuations actually don't look all that extended in the Mag 7 and the top 10 names.
That's a terrific point because I think history shows in this country when companies or the company and the country in general, when they invest in the future and research and development, innovation, tap into that dynamic aspect of the American culture, you usually get a good payoff. And so that's an optimistic point about what might come. And a lot of Americans, I think, people that I talk to, they may not factor that in just with all the noise that's going on in today's world and news cycle and such. Let's talk about inflation. You touched on it at the beginning. Inflation peaked at around 9%, I believe, in June of 2022, and it's come down fast, much faster than most people bargained for. And that helped the market have the rebound it did last year. So talk a little bit about the outlook for inflation. And I still believe that the inflation story is still central to the success for the economy and by extension, the market. So I think this is a really important topic. Talk to us a little bit more about the inflation outlook.
So inflation, again, at the outset, we expect inflation to reach 2%. We actually think inflation could reach 2% by the summertime. And so inflation has continued its disinflation downtrend. Over the back half of last year, there was we've been waiting for big components of inflation, namely shelter and rent inflation, to come down and really more acutely reflect what we're seeing in the spot market, the home price and the rental spot market. That has been slow to feed through to sort of the inflation numbers, but we do think they'll start to feed through more meaningfully over the first 6 months of this year, and that can allow for some pretty significant disinflation to feed through into specifically core inflation, which is now running at about 3.9% year over year. I will also say that I try not to fall prey to year over year figures because you could be subject to base effects. And so I think a cleaner way to look at inflation is either on a 3 or 6 month annualized basis, because that gives you a cleaner measure of the momentum in inflation. Right. In fact, when you look at the 3 and 6 month annualized run rate on core CPI today, it's at about 3.2, 3.3%. So a decent chunk lower than the year over year run rate that we're seeing, and again showing signs that inflation is trending in the right direction.
I agree with you. Not that your opinion is you're more accomplished in this realm, but I agree with you. The run rate's more important than the year over year. I know it's an easy thing to look at the year over year, but I think it's a misinterpretation because inflation is mostly is trends, runs on trends. I think you would agree. Generally, you don't have inflation down 1 month, up the next month, down. You tend to be trendier than other things we might look at economically. So I love that point. It's a valuable one. As we kind of begin to wrap up, I know this isn't a political show, although I do love talking about politics. But this is an election year, 2024, and there's a lot of cross currents going on, including geopolitical risk, which we haven't even gotten into, where you still have, shooting in Europe, you have shooting in the Middle East. There's a lot going on that is upsetting as well as dangerous economically and otherwise. But just the election year, I've been describing to clients, Jordan, that it's going to be a zoo. If it plays out the way that it seems, and you have President Biden going up against former President Trump again, it's going to be a zoo politically, and it's going to be highly charged. A lot of people get emotional over it. But talk a little bit about, before we finish, how election years historically matter, and sort of separate out just the hype of what might be looking forward to or not with a Biden-Trump kind of rematch. Talk to us a little bit about just the analytics of history.
Sure. Well, historically, from a capital markets perspective, in election years, you tend to see one, lower returns, two, higher levels of volatility. And that makes sense, right? Markets don't like uncertainty, and elections present another layer of uncertainty to the broader markets. And so historically, what you tended to see play out is that markets are somewhat flat, certainly a bit choppy, leading up into the election, but then markets tend to rally pretty strongly in the fourth quarter, now that you have more clarity on what the administration is going to look like over the next 4 years. And you really hit the nail on the head in terms of, oftentimes consumers will fall prey to how they feel politically, and that thereby dictating their overall investment decisions. And that is something that we would strongly advise against. Investors should never allow how they feel politically to dictate their overall investment decisions. But we have some interesting data that looks at historical consumer confidence amongst Republicans and consumer confidence amongst Democrats. And it's fascinating because both Republicans and Democrats are living in the same exact economy, but based off of who is in office, they view the world very, very differently. So, unsurprisingly, under President Obama, you saw Democratic confidence move higher. Under former President Trump, you saw a Republican confidence move higher over those 4 years. But I gently remind investors that under President Obama, the equity market returned about 16.3% annualized from Jan 09 to January of 2017. Under former President Trump, the equity market delivered 16% annualized, so almost identical from 17 to Jan 2021. And so if you were a Republican that stepped out of the market under Obama, or if you were a Democrat that stepped out of the market under President Trump, you probably missed out on some very, very strong returns. And so it's just a gentle reminder. It's policies that matters for markets, not politics. And again, don't allow how you feel politically to think about how you make investment decisions. Remember, we invest for market cycles, not presidential cycles.
Well, that's a great place to leave it, because that is terrific advice that anybody listen would be wise to heed, especially in this emotionally charged election year that we're probably in for. So I know I thanked you at the top of the discussion. I want to thank you, Jordan, for taking the time. Thank JP Morgan and my other partners and friends at JP Morgan for putting this together. I greatly appreciate it. It's very valuable. Helps me do my job, hopefully better than I otherwise would. So again, I'm so appreciative, and I hope you, your family, and everybody on your end has a wonderful, wonderful 2024.
Awesome. Well, thank you very much, Chris. Really appreciate it. And cheers to what we believe to be a strong 2024.
Thank you.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.